2026 is here and the world is recalibrating from shifting global growth expectations to Africa's uneven recovery, to South Africa's make or break reforms. The year ahead could redefine the economic narrative. So how could it all play out? This is Insights from Africa. I'm Bronwyn Seaborn, and on this episode, we unpack the global currents, the continental shifts, and the local realities that will shape the year ahead. Well, if 2025 was the year of uncertainty, then it seems 2026 is shaping up to be the year of recalibration. From slowing inflation and shifting interest rate cycles in the world's biggest economies to fragile growth in Europe and renewed momentum in parts of Asia, the global outlook is cautiously optimistic, but far from settled. Zoom in on Africa and the picture becomes more complex. Growth is expected to recover in key economies, helped by easing debt pressures and infrastructure investment, but currency volatility, energy constraints and geopolitical risk remain firmly in play. And here at home in South Africa, 2026 could be a defining year. Can structural reforms finally translate into meaningful growth? Will confidence return to drive investment and jobs? And what about the looming municipal elections? To unpack it all, I caught up with Standard Bank's chief economist, Gulam Balam, and started off by asking him if we're in a state of disorder on the macro front, given all that's at play right now. So let's take a look.
Initially, it may have felt so, meaning a year ago, but now I think there's increasing clarity that we're in a state of contested disorder. In other words, people are beginning to grasp that it is not the institutions in multilateralism of yesteryear that is shaping international diplomacy. Instead, what it is the strongest nations that are asserting themselves. So power, coercion, and harnessing economic tools for self-interest. The weaponization of economic tools is the order of the day. And in some respects, it introduces a little bit of predictability in terms of anticipating what will happen with the evidence of 2025. I guess the second observation is that geopolitics is now at the core of influencing markets and decision-making. In other words, we don't just look at economic data, but we look at political intent to frame the type of market and real economy impact and implications it could have.
Leading on from that, there was a real fear, or there was a real sense that last year was going to be a bad year for the globe, really. And yet we didn't see that come through in the growth figures that we saw. And I suppose last year, if we really want to get into the nitty-gritty of it, was really this tale of two halves, right? So what were some of the things that contributed to the more positive picture that we ended on last year?
So peak tariff fear, in fact, occurred on Liberation Day. In the aftermath of that, average tariffs with respect to the United States war subsided and dialogue began. So there was enormous reprieve from the tariff fears in the latter half of last year. Combined with that, there was a pivot by many central banks around the world where they shifted from earlier tighter monetary policy to interest rate relief. And that then introduced a significant tailwind into the global economy. And perhaps the third reason was the enormous investment that has been going into new technologies, most specifically artificial intelligence. Buoyed stock markets, it lifted confidence, and the accumulation of those forces, although not exclusively, helped to deliver a 2025 which was in fact better than the forecast even before Liberation Day.
And that then framing where we take off from now into 2026, you did highlight it at the beginning there. It's a time of perhaps not calm, but some predictability. When you say predictability, what do you mean by that? Do you think it's in the truest terms of the word that I now know how things are going to play out? Or what are you meaning by predictability?
It's not the most elegant way to describe it, and I really don't want to be reaching for Donald Rumsfeld's framework. But a year ago, we would have had a big bucket of unknown unknowns. And we think that a number of items and themes have slipped from unknown unknowns to either known unknowns or known knowns. So, for example, inflation did not rise. It remained fairly pedestrian. Central banks eased into that deflation. We know that there is the so-called taco trade. Trump always chickens out. In other words, there is much bluster in terms of assailing other nations, followed by relief and negotiations. And so markets have to some degree anticipated that those injunctions by the U.S. Federal Reserve, by the U.S. President, tend to be brief and not perpetually roiling. I think the second observation I would mention is that the world adapted fairly quickly. Supply chains reconfigured. Firms found new markets. Firms did not totally retrench investment. They simply reallocated investment decisions. So adaptability was a key feature of the second half of last year, and it delivered steady, if not unspectacular, growth. And I think in 26, again, steady, if unspectacular growth will be the norm.
Steady, if unspectacular. What figure are you putting at that in terms of growth for the globe and for the US, given its status in the world order?
So the US could muster a little bit better than 2%. Global growth a little better than 3.5%. And that'll be a function of fairly fervent growth in Asia and also Africa, small in global GDP scale, but Africa mustering 4.5% to 5%.
Let's hone it down then and come to sub-Saharan Africa and how it plays out now in this global context. You've highlighted that trade really came to the fore for the continent, and so interesting given all the trade dynamics that are currently at play. So walk us through that. When we talk about trade and it being a cornerstone in sub-Saharan Africa, what is meant by that? Is that our trade with partners outside of the continent? Is that our trade with partners inside the continent? What are those dynamics shaping up to look like?
So, Bronwyn, we argue that trade has been this quiet engine of growth for a length of time. Trade in sub-Saharan Africa accounts for around 50% of GDP, dwarfing, for example, fixed investment share of GDP, remittances, and even aid. So it's a fairly substantial part of the Africa growth equation. And it has been benefiting by a pivot to new partners. So Asian trade, for example, now dwarfs Western Hemisphere trade. And Asian growth has been more lively, speaking to Africa potentially exporting into larger markets. There's also a new kid on the block in the form of the Middle East. In fact, Middle East-Africa trade now surpasses US-Africa trade. The Middle East is also a very substantial provider of liquidity or capital. Indicatively, in 2022 and 2023, over 2 years, the Middle East provided about $113 billion of capital to the continent. It was 3 times what China provided over that period, and it flowed into electricity, ports, and just general logistics, amongst other sectors of the economy. So, yes, the external environment has altered materially. It's been an underpin to growth, but I'll quickly add as well, endogenous growth has also been supportive, and for numerous reasons, including falling inflation and falling rates across the continent.
When we talk about trade, we can't sideline the commodities boom that has happened, and that's certainly giving an uplift to trade in certain areas. But the big question around the commodities boom, and as we love to hope, I guess, is that it would create this windfall for many African nations. Is that windfall being taken advantage of enough? Because it's one thing to have this commodities boom, it's one thing to have the trade come through, but unless we can really translate it into real growth, it's kind of something that, we're not really taking advantage of enough. Do you see that windfall being taken advantage of as we talk about, Africa rising, etc.?
Bronwyn, it's good to have a healthy level of cynicism. Past commodity booms have been wasted. It's often been the case, but there's little to show in its aftermath. So it's right to question whether this time will be different. And I suspect even if completely, entirely, but partially, much of this windfall in several countries seems to be flowing more substantially to, for example, utilities infrastructure. If we just look at South Africa, the windfall, which will be material this year, stemming from the profits that mining companies will make, and it'll help buoy overarching revenue, in the hands of a constructive finance minister like Minister Konungwana. We're likely to see him apply it, for example, to elevated infrastructure spending, reducing the tax burden in a manner that where previous tax increases may now be ameliorated, and helping to contribute to having indebtedness peak. In other words, the commodities revenue in South Africa will aid fiscal consolidation, helping to boost perhaps sovereign credit ratings prospectively, helping to lift confidence and just belief that public sector finances are in good hands. So yes, here locally, and I think across East Africa, a few nations are showing constructive reforms, and even, for example, in Nigeria, where admittedly it's a monoline economy dependent on oil with respect to resources, but diversification and FX reforms are propelling that economy to slightly stronger mid-single-digit growth than recent years. So I would say the reform agenda in Africa is tilted to the right direction. It'll be inching rather than a material leap.
We're hitting pause on the conversation there, but when we come back, we hone in on South Africa and take a look at what 2026 could have in store for us. So more of that detail right after this, so don't go anywhere.